Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Now, the market's slow climb higher has some reassessing their hedging strategies. Joining me now is Michael Lucas, the CEO of TrueShares ETFs, alongside Tony Kelly, the co-founder of Bond Blocks. And Mike, we're going to kick things off with you and the markets. This is a market that over the last several weeks and months at this point seemingly just sets record high upon record high upon record high. Today is no exception to that rule here. So take us through just what you think this current market and its behavior is like, and just how much more upside do we think there is for equities in the S&P 500?
Well, I'll give you the shorter answer first, which is I don't know how much more upside there is. And to your point, this keeps grinding higher and higher, and we've got so many factors in play. We've got obviously tariffs. We have rate cuts potentially. We've got a massive earnings week, and how much longer can the AI boom, carry the market? So lots of factors in play. But I think by and large, investors are still cautiously risk on. And it's because of those reasons, because the catalysts are so diverse and varied that any one at any given time can create some uncertainty and or momentum in the market. But we'll see this week. We'll see what earnings look like. And, if these valuations can continue to be justified, then you've got some potential tailwinds here. But again, investors, they might be risk on, but that risk on comes with a caveat. They definitely want risk on with some actual protection, or at least some downside mitigation just in case.
Mike, what do you think? You laid out a kind of a mini laundry list, if you will, of potential kind of catalysts or influences on the market. What do you think right now, in your opinion, in your expert opinion, is the kind of biggest one or two motivating factors for what's really driving the fundamentals behind the market?
Well, I think it's AI. Tony and I were chatting about the fact that we're both here in the Bay Area right now, and certainly we're in the heart of it. And I think that the AI, the AI boom, if you will, is carrying the market to a certain extent. And I think things to look for this week, when you have a lot of these large big tech companies reporting, is what their CapEx looks like and what they're spending on the AI, pick and shovel. And that will give us a pretty good idea if that momentum continues. But, I think that's the story, frankly.
All right. Now, let's talk a little bit, Tony, about this idea that the bond market has seen maybe returns that aren't too shabby either, especially in the last few weeks or so, given this idea that, with the economy, yes, maybe showing some signs of slowing down a bit, is still fundamentally sound, at least from a labor perspective for the most part, and inflation certainly seems to be under control. And then you add on this idea that the Fed might move to lower interest rates more so before the end of the year. That's providing a tailwind for the bond market. So where exactly has been the activity in the bond market these days?
Yeah, thanks. That's interesting. The investors have been, piling into fixing of the last couple of years. I think even as equity markets grind higher, we hear from clients they are looking to diversify that risk and lock in some of those returns. Some of the areas that we've seen a lot of folks short duration for the last couple of years, both in treasuries and in credit, have seen a fair amount of flows, but it's kind of across the board. Even, as credit indices are paying 5-6% in yield to maturity on investment grade exposures, those are interesting to clients as well.
Now, is it just about the rate story? Is it just about what's happening with treasuries? Or do you see a more fundamental shift, perhaps, in the way that investors are viewing certain key parts of the bond market, given what we now see in the equity markets, being with key drivers there like AI, technology, and everything else? What's the key driver here, one or two drivers, for what's happening with bond price action?
Yeah, I think it's a couple things. I think historically investors look to the bond market for diversification, to diversify that equity risk that's in their portfolio. They look for it as a source of stability. You can think of it as sort of a ballast in the portfolio. And then the final component is the income component, which is great most of the time, and then it's even better. It kind of cushions those drawdowns, and it's real nice to have that in the portfolio when things get a little choppy.
And certainly that idea of having that ballast or the kind of hedge, if you will, in place is something, Mike, that you have made a living doing over the last several years here, specifically with regard to those buffer type ETFs that have a more defined outcome, that kind of limit the return profile to a certain band on the upside and the downside and somewhere in between. How much more demand have you seen for those types of products, those so-called buffer or defined outcome ETFs, over the course of the past few years, certainly since the pandemic?
Well, it's gone meteoric, right? And I think that it goes back to what we just mentioned about what investors are seeing in the marketplace right now. Look, we've got a massive demographic shift happening in this country, and lots of investors are moving, or a great deal of wealth is moving from the accumulation phase to the distribution phase. Now, a lot of those investors still need growth, but they need growth with risk protection. And the defined outcome space, and let's be realistic about it, the buffered space is probably the first wave of structured product strategies, traditional structured product strategies, jumping the fence into the ETF wrapper. And so we'll see the second and third wave of that begin to happen. But what this is allowing investors to do is create individually customized portfolios with a defined risk level. And, it sort of dovetails with the phenomenon that I call performance that's good enough, right? So 30 plus years in this business, most of those years were spent chasing the S&P. Well, there's a type of investor now, and that investor pool is growing, that has a target in mind for their growth as well as their risk. And the ability to customize portfolios and deliver that risk reward ratio that each individual investor is comfortable with is really behind the boom in not only buffered ETFs, but defined outcome space in general, which involves all sorts of different hedging techniques these days.
Mike, those hedging techniques have now evolved again to kind of the next evolution of these buffer or defined outcome ETFs. And those are the uncapped ones. And you're an ETF manager that has kind of been one of the folks out in front of the idea of an uncapped buffer ETF. So for the viewers and listeners out there, you have this kind of idea that you can have a defined downside, right, in this, but you don't have to be limited for the upside gains. And that means a lot more in a market like we're seeing right now, because like you said, we're grinding higher, sequentially making kind of fresh record highs, not in blow-off, fashion, but just kind of like the slow melt-up. What exactly is the demand profile like now for these so-called uncapped buffer ETFs that still give you downside protection, but then let you participate much more so in the upside? And what exactly does that cost an investor?
Well, I think that the understanding that, equity returns are not linear. Typically, they're fairly lumpy. And as we see instances of those non-sequential returns, and we saw it in 2020, we saw it this year, right? If you look at the sort of the flash crash around Liberation Day back in April and what the market's done since. So you see fairly significant gyrations in the market, and understanding what happens during those periods, it's a bit of a behavioral finance approach, but what happens during those periods has started to open the eyes of many investors to the idea that, okay, look, mitigating risk is great. I would like to do that, but we also need a way to harness those big, chunky upward moves. And historically, a lot of these snapbacks happen after significant drawdowns, a way to protect myself just in case there are additional gyrations or drawdowns, and also participate to the extent possible in the upside. And so your question is, what does that cost? And so a lot of our peers in the space work with a capped upside, and you get 1-to-1 of the upside. And for certain investors, that's great. For other investors that are more conscious of what happens in a significant up move, then we offer them a participation rate or an upside capture rate rather than a 1-for-1. what that allows us to do is historically deliver anywhere between 75 and 85% upside capture without a limit. And in years where the market's up significantly, or 12-month periods where the market's up significantly, the difference between capturing that upside or capturing a big chunk of that upside versus being capped out when it comes to long-term compounded returns is hard to ignore. I think investors are wising up to that situation the more they see significant snapbacks following meaningful drawdowns.
You know, Tony, Mike brings up an interesting point with regard to the behavioral finance, behavioral economic side of just how things have evolved for traders and investors. The most traditional kind of equity hedge out there for decades now has been the bond market, right? This idea that you allocate differently between certain risk assets and bond type assets to make sure that you're always in a risk profile that's appropriate for that particular investor or trader. I wonder if you could take us through a little bit about how you've seen that behavioral element evolve towards the bond space, given the idea that there are so many more complex products like what Mike manages over at TrueShares for defined outcome equity, uncapped buffer, and everything else. What exactly has been the investor sentiment like for the bond market? And is there still a role for just a straight stock bond allocation in this portfolio, or is everything just getting much more nuanced and complicated these days?
Well, it's definitely getting more nuanced, and I think that's actually what I would describe as the trend over the last 10 or 15 years. 15 years ago, I think most advisors would think about their asset allocation as some split between equity and fixed income. On the fixed income side, there was probably one solution, call it the AG, and they would probably spend more time developing out the equity side. That's actually what we have seen shift and change over the last few years, because all asset classes, even within fixed income, are not the same, right? There's quite a dispersion between returns and opportunities. And that's what we've seen sort of shift and kind of play out over the last few years, is advisors are being a bit more thoughtful because there is more opportunity in fixed income now that rates are no longer, close to zero. And then there's product opportunities, right? So there's emerging market debt, for example, is one of the top returning asset classes in the fixed income market this year, is up well over 10. And that comes along with all those benefits of diversification, lower the overall risk in a client's portfolio. So that is kind of what we are seeing continually play out, is this more granular view of the fixed income exposures in clients' portfolios.
The nuance and the kind of, custom tailored approach is something that we've seen and discussed now with regard to the buffer side of things on the equity side. How far, Tony, are we away from seeing way more robust structured type products enter the fixed income ETF market? I mean, for me, back in my Wall Street days, structured products were almost exclusively pretty much geared towards fixed income, currency, and commodity type situations. And then they kind of evolved out to be a little bit more sophisticated on the equity side of things. But for bond investors, is there a next evolution, so to speak, for some of these types of products for bond ETF investors with regard to defined outcomes, and just how big of a market would that be?
Yeah, I mean, I think Mike could probably comment on this, and that probably is in the future. There's still a lot of white space, just even in the more straightforward traditional fixed income asset classes. Like there's a lot of talk, for example, private credit, right? I don't know if that is something you would necessarily refer to as plain vanilla, but there is a lot of interest in that subset of the fixed income asset class to be in an ETF wrapper for clients.
And Tony, one final point about that. If you do see the types of products that we have seen come out for fixed income, what exactly, as an ETF manager yourself, would you expect to be the next evolution for bond ETFs? What would you like to see out there, or what kind of things are you contemplating at Bond Blocks with regard to what the next product could be, the next big thing in ETFs for bonds?
Yeah, I mean, there's still, like I said, a lot of white space, a lot of segments of the market that have not been delivered, and we're spending a lot of time on that. Private credit, as I mentioned, is an area that we're spending a lot of time on. We do have a private credit ETF product in the market now. We've got one in registration, but there's still plenty of room, even in the traditional asset classes and fixed income, to deliver access to.
And Mike, a final point to you here. As we talk a little bit about the way that these buffer ETFs work, there's been a lot of debate for several years now at this point, maybe 2 or 3 years at the very least, about the back and forth about whether or not these things are suitable or whether or not the costs associated with the higher fee structure for some of these is worth it in the end for investors. From an ETF manager's perspective, we know that, you make your money managing buffered ETFs. But just what exactly do investors and traders need to understand about the performance and risk profile of buffered ETFs vis-a-vis the types of fees being charged versus just, say, a regular S&P 500 ETF?
Yeah, and that debate, I think, has raged for a while, particularly as buffered ETFs started to garner a larger market share. But the reality is these are essentially math-based products. And while I'll say that as a math-based product, they typically will deliver on what they're supposed to deliver on. However, matching expectations with investment objectives is still paramount in this space. And as it is with any investment space, I think the ETF space in particular tends to suffer on occasion from a little bit of ticker soup, right? When you find a segment that works or starts to get crowded, you'll see dozens of variations on that approach. So in the defined outcome or the buffered space, education is key. Matching time horizons, investment objectives, and risk profiles with the actual product or the strategy, I think, is as important as anything when it comes to investor satisfaction. But again, let's not forget that this is a bit of behavioral finance in the sense that investors that are approaching defined outcome, investing in defined outcome, they're looking for a smoother ride. They're looking to go to sleep at night, not have to worry about what the market's going to do first thing in the morning. And there's a value to that. There's a value to assembling these products, making them turnkey in the ETF wrapper, which, depending on your perspective, is probably more investor friendly than some other wrappers available. And having the ability to do all that in ETF for most investors justifies the fee. And I think that's an accurate portrayal of it. If it matches the risk-reward profile and allows an investor to target their particular risk spectrum effectively, then it's typically worth what you're paying for it. Now, there are some outliers to that discussion, of course, but by and large, I think that's the perspective that I stick with.
All right. Suitability and expectations always key for any type of investor out there. Mike, Tony, thank you both for being with us here on ETF Edge. Now, we've asked Tony to stick with us for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching, and we'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.